So the first point I really do want to make is that the economy is not the same thing as the financial market. The markets tend to move about 6 months before the economy. So that's really important at the moment because interest rates are one of the biggest drivers of markets right now. And of course, interest rates are going to start to fall well before economic growth accelerates. But the markets are forward looking, so they're going to be anticipating that and moving ahead of that. So markets will depend on interest rates primarily. Currently, they're expecting only really minimal cuts to interest rates next year. So that message of higher for longer that has come out from central banks, not only in the UK, but actually around the world, that has definitely been heard and priced in now by the market. That's what really lay behind a lot of the recent bond market weakness, because we had to go through that period of adjustment for expectations. Because the good news here is that the global economy has actually been holding up better than expected. And that's one of the reasons why the central banks have to say we've got to keep interest rates high to continue to fight inflation, because actually growth hasn't been coming down. And then the other two main drivers of markets are inflation and economic growth as well. So I'm going to talk about each of those in turn. Inflation is definitely coming down. So in the UK, it was 10% at the start of the year. It's now 6.7%. That recent oil price spike that we saw over the summer months really did slow the fall. We saw that decline sort of stutter a little bit. But I think that's just a blip, to be honest, because we've seen oil prices continuing to come down again in sort of more recent days. It looks like the conflict in Gaza will be contained. And at the same time, we're seeing the Chinese economy weakening. So that's pulling down oil prices. So, I think that's it. That does suggest that actually inflation in the UK is going to continue to sort of come down in months to come. And when we look at it elsewhere, we've got the Eurozone inflation back at 2.9%, the US at 3.7%. So it's really not the monster that it was. It's more of a sort of a gremlin now. I think the UK does stick out for having a bigger problem than anywhere else. That's down to a shortage of labour predominantly, but it's also because of our reliance on energy and food imports. And then economic growth is really the final part of the puzzle impacting market returns, even though, as I said, the market moves about 6 months, give or take, ahead of the economy. So when we look at the signs around growth, it's kind of a mixed picture, but there's some patterns forming. So firstly, the lagging indicators, which look backwards, generally look a lot better than the leading indicators, which make inference about future growth. I think at the headline level, that's really because the slowdown that was expected this year has probably been postponed a bit. The lagging indicators also show a global economy that was a lot more resilient than a lot of people were expecting, I think, because we've had a lot of pent-up savings from the pandemic, pent-up demand for hospitality and travel as well. Interest rate rises taking even longer than many expected to feed through. And so GDP growth has actually been pretty resilient this year. We've seen positive revisions of GDP growth in the UK. In the US, retail sales have been continually strong. And corporate profitability has been better than expected as well. When we look ahead, I think we do see some sort of clouds appearing on the horizon, though, if you like. We've got weakening consumer confidence trends. We see slightly weakening surveys from the business sector. But then again, it's a mix. We can see that the service sector is starting to dial back their expectations. But at the same time, actually, we've got perhaps the green shoots of recovery coming through from US manufacturing. So it's mixed rather than being, overly negative. And there are still some really positive tailwinds coming through that I think are going to be universal, regardless of what happens to the economy. And this is good news for the markets because it's things like AI, which is driving investment in chips, for example, in the US, because they want to know for sure that they can compete in what's going to be really the pinnacle of digital growth, I think, for the next decade, if not longer. We've got, again, innovation coming through in the pharmaceutical sector, where the RNA vaccines that work so well in the pandemic are now being expanded for other treatments. We've got anti-obesity medications as well, which have been they've seen incredible uptake over the last 12 months. So there are still sort of secular tailwinds, if you like, that are going to continue regardless of sort of what happens to the overall economy. So there will be, winners as well as, areas of weakness in the 12 months ahead.
So you mentioned clouds, so there are a few things we've got to watch for, but overall you're feeling a bit more positive, perhaps. I'm getting that impression. Is that right?
So yes, I'm more positive on financial markets. not
Okay.
so positive on the UK economy is definitely going to go through a weaker period, in the year ahead. But I think that what we are seeing now is that we're close to, probably at peak interest rates in the UK. I think we're very nearly at peak interest rates in the US. And that means that whilst we'll probably see an economic slowdown in the US, weakness in the UK and Europe, actually probably 6 to 8 months away, we've got interest rate cuts coming through. And what our data shows is that in the 12 months after interest rate cuts begin, then you tend to see pretty good returns coming through from equity markets and actually bond markets as well. So yes, I'm becoming a bit more optimistic about markets in the year ahead.